When Congress enacted the sweeping health care reform law earlier this year, it contained a modification to the U.S. tax code that generated a lot of commentary both within the realtor community and outside the realtor community. Under the modification, households earning $200,000 a year or more if they're individuals, and households earning $250,000 a year or more if they're married couples, would pay a 3.8% tax on investment income that's above a certain level.
The biggest misconception about this tax is that it is a transfer tax on real estate. It is not. It is a tax that will never hit anybody with less than the $200,000 or $250,000 income levels that you mentioned. And it's also a tax that's just imposed on a sliver of some kinds of income. And so the taxpayer, first of all, has to figure out what all of his income sources are, just in the same way they do for their filling out their income tax return. Then they segregate out what is called their investment income. Now, investment income is all your dividends, all the interest payments that you receive, any taxable capital gain that you have, and if you own rental properties, on your net rental income. You then add up all of those things, and if you're at $250,000, let's just assume it's a couple, then you have to figure out how this tax applies. So let's just think of a family who sells their principal residence and has a gain of $525,000. For regular income tax purposes, $500,000 is excluded, $25,000 becomes a taxable gain. Before they add in that taxable portion of their gain when they're computing this new tax, let's say that all the rest of their income combines to $325,000. They add back their taxable gain, in this case $25,000, and so they have a new adjusted gross income of $350,000. And so they'll compute, first of all, the excess of that $350,000 over $250,000, and that is $100,000. And then they'll take the $100,000 number and compare it to their investment income, which in this case is going to be their $25,000 taxable gain. So when they have those numbers figured out, they look at and determine which of those two numbers, the excess or the smaller number, which is the smaller number. And in this example, the smaller number is their $25,000 of taxable gain on the sale of their principal residence. And so then they'll take that $25,000 and multiply it by the 3.8% rate, and that comes out to a tax for this purpose of $950.
Well, shortly after the law was passed, many are posted and distributed a fact sheet that explains how the modification works. So what any of our members will find is that on Realtor.org there will be 6 or 7 of these examples of different financial scenarios and how the tax might apply in these specific cases that you'll be able to look at carefully, and they're also in a brochure that you'll be able to download and access. So the law passed in early 2010, and this tax modification is part of that. When does this kick in, and what can we will there be rules written? Will the IRS come out with a notice? What happens next?
The tax doesn't go into place until 2013, and yes, the IRS will provide guidance. They'll provide, especially I think they'll make it clear very quickly that people are protected on their $250,000, $500,000 exclusion amounts. They'll also no doubt have have pretty detailed examples for folks who own rental properties. Interest and dividends, you get that information from who's ever paying you that amount, so there's not a lot of complexity associated with that. You'll still get those notices from your broker, from your mutual fund, and so that the dividends and interest part will be pretty straightforward. And so the biggest area of concern for the IRS will be the application on rental property. An important thing for realtors to remember is that if they're working with upper income clients, they need to be sure the client knows about the tax, but they also need to send that client to a tax advisor, because this tax is a formula that requires a lot of steps, and you can never generalize and say it's always going to apply here, it's never going to apply here, because it's going to depend on each individual's mix of all the elements of their income.